Tesla shareholders have been hit hard, with the stock dropping to $150 per share, down about 62% on the year, causing many to become frustrated with CEO Elon Musk. However, while Elon has been dropping his kids off at the pool, he's taken to Twitter to reassure investors that Tesla will be great long-term, despite macroeconomic headwinds. Yet there are new rumors coming up every day that Elon Musk isn't focused on the company, or that he's being replaced, or that demand for electric vehicles is waning. Even if Tesla demonstrates large advancements in the business, investors seem to be more focused on the glass half-empty side of things. This may mean that shareholders are concerned or even scared of Tesla's future, given one negative headline after another. As Warren Buffett's mentor, Benjamin Graham, once stated, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." And although it seems like investors are voting that they're unhappy by selling, many may be sitting on the sidelines waiting for the noise to clear up with some tangible news from the company. Although we learned this week that Elon Musk has sold more Tesla stock on the order of $3.6 billion, likely to be used in further financing Twitter. While this came as a surprise to many investors, in retrospect, there have been some very subtle hints within Elon Musk's tweets where he's been advocating against leverage. Twitter has some leverage due to the acquisition, and therefore he may be taking some of his own advice, which happens to affect Tesla's stock price in the process. Nevertheless, Tesla's underlying business may be making large strides of progress at a time when competitors are forced to cut back. Earlier this month, Tesla leveraged their expertise in China by bringing their top executive, Tom Zhu, along with other engineers, to the United States to help optimize Giga Texas. Tom Zhu has been responsible for leading and overseeing the rapid construction operations at Giga Shanghai, a Tesla Gigafactory that was brought up in record time, about 10 months, before being ready for production, and currently has grown to outpace Tesla's other 3 car-producing factories combined, with a run rate of 1.2 million vehicles per year, given November's strong 100,000 unit production number. Now the rumors quickly turned this into a negative, saying that Tom Zhu would be replacing Elon Musk. However, Elon has tweeted multiple times that he's still spending time working hard at Giga Texas. Tesla also expects to start Cybertruck production next year at this factory location, and they continue to ramp up 4680 battery cell production. So transferring the learnings between the two factories could help to greatly boost Giga Texas production and perhaps prepare Giga Shanghai for new products or components. At the same time, Tesla just announced that a new milestone of 3,000 Model Ys produced per week has now been achieved at Giga Texas, or a run rate of about 150,000 units per year. And just now, Giga Berlin made the same announcement for its own factory. This helps to answer fears about growth and production, but what about demand? And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Last quarter, we saw Tesla change the way they deliver cars. Elon Musk has been talking about this for quite some time, but it seems like last quarter they actually hit sort of a physical limit where the cost to deliver vehicles spiked since Tesla exhausted their delivery capabilities during peak times. So Elon Musk said, "That's it, we can't do this anymore, we're going to try and smooth out deliveries." And so the advantage of this is lower delivery costs, because for instance, Uber prices explode when Tesla decides to hire every Uber driver available and then some in order to help with deliveries. Another advantage is that you can have higher utilization of the delivery infrastructure if the deliveries are constantly elevated all quarter long, which will be important as Tesla continues to expand. Albeit it takes time and some learning to be more consistent with deliveries, it's not something that happens easily overnight. Now the disadvantage of this method is that there likely won't be an end of quarter delivery push like we've seen in the past. Now, who knows if they are indeed still pushing because it's the end of the year. But actually, there's really no longer a need for an end of year or end of quarter push because anything still in transit simply gets delivered in the first few days of the following quarter. Long term, you'd much prefer this option since overall Tesla would save money by not paying peak prices. And as we saw at the beginning of this current quarter, Tesla had about 20,000 units that were built in Q3 that were delivered at the beginning of Q4. That's the end of quarter push. It just happened at the beginning of the quarter and now more consistently throughout. Now, Tony Saganaki, who's an analyst at Bernstein, and he's always been bearish on Tesla stock with a $150 price target, is right on the money right now as Tesla just hit its forecasted price. Of course, CNBC is encouraging him to further lower this price target now that it's been hit. But his fundamental bear case issue is that Tesla has run out of demand, and the evidence of this is Tesla slashing prices by $3,750 and giving 10,000 miles of free supercharging to buyers who accept delivery this year in 2022. And that's a lot of supercharging for many, about a year's worth of free power. And it seems like other geographies, not just the US, are also getting some end-of-year perks to take delivery. For instance, in Canada, it's 10,000 kilometers of free charging. Now, Saganaki also cites that last quarter, Tesla fell short on deliveries, alluding to more problems. This makes it seem like Tesla is done for, the story is over, and there's no more growth or demand for electric vehicles for years to come. Interestingly, he even says that there's no new high-volume product coming anytime soon, alluding to a low-cost vehicle on Tesla's roadmap likely for 2024, but right now they're going to have to cut prices which will eat into their margins, or the growth rate will have to slow down, thus reducing sales. And he emphasizes that this will be challenging for the next few years, which is a pretty bleak picture for any shareholder to hear. Now, this sounds convincing, but he fails to mention a few things which may put a big hole into each of his arguments. Tesla missed expectations last quarter due to the aforementioned smoothing out of deliveries. This should be a one-time thing if Tesla gets it right, affecting only the previous quarter, but going forward, shareholders shouldn't notice a difference. So extrapolating this concern doesn't make much sense. Furthermore, completely and purposely overlooked during the interview between CNBC and Bernstein are the massive upcoming tax credits that Tesla gets, which are heavily contributing to causing people to want to delay delivery until next year. So whatever discount Tesla is giving today is temporary, because next year, which begins in 2 weeks, Tesla may, counterintuitively to these analysts, have so much demand that they once again may not be able to keep up. Tony Saganaki says, "We believe Tesla may need to make additional price cuts in 2023. Well, 100% the price will drop in 2023, but that's not going to hurt margins or profitability since the government will be paying the difference. If anything, Tesla should increase prices by $3,750 to split the difference with the consumer and actually increase margins. But it doesn't seem like they will do that, otherwise it would have made more sense to announce that already to prevent people from delaying orders. So indeed it looks like consumers will benefit from a massive $7,500 price cut in the form of credits, which could light a fire under Tesla's sales, given how well their vehicles have been selling all year. We also talked about in previous videos that Tesla will be improving manufacturing efficiency, specifically at Fremont, to even further reduce costs. So things actually get a lot easier in 2023 in terms of finding demand with more attractive pricing. Saganaki continues by saying, if you have a company that's growing at 40 or 50% per year and you're struggling with demand, that's the principal fundamental issue. But if electric vehicles were crushing ICE vehicles in 2022, putting up massive growth numbers into a declining auto market, and then now you throw in at least $7,500 extra for the majority of Tesla's vehicles, not to mention battery credits, which consumers don't see directly, but will further reduce Tesla's costs. How much can that increase demand? EVs were already competitive with ICE cars economically, since they're much cheaper to operate. It was just the sticker price that was higher, even as it continues to approach parity and ultimately become cheaper than an equivalent ICE car. The $7,500 is a very big deal as it drastically accelerates this trend and benefits only electric vehicles. Note that Elon Musk didn't want any sort of tax credits. He suggested canning the bill, but the government went forward with it anyway, and now Tesla will be the largest beneficiary of these credits. We're also starting to see inflation pressures ease, which further helps the consumer by reducing costs for Tesla, allowing them to bring down prices more naturally going forward. Keep in mind that Tesla heavily increased prices over the last year to keep up with inflation. The purpose of this slowdown caused by the Fed is to reduce inflation, which ultimately should help lower prices back down while Tesla maintains its industry-leading margins. It's worthwhile to note that Tesla, along with the entire EV industry, make up just a small percentage of the overall car market. They've grown abundantly this year, even as the market contracted due to parts and supply shortages, thus eating broadly into the ICE vehicle space. Even during the 2008 recession, where we saw high unemployment and it was devastating, the car market certainly dropped, but it didn't evaporate. There are still many cars sold during a recession year. And so because EVs make up such a small percentage of the overall car market, and they're becoming the preferred vehicle, any slowdown would drastically affect ICE vehicle makers much more, and less so electric car sales. Now, in a separate CNBC interview just days ago with Perma-Bear Gordon Johnson, he says that lead times for Tesla, the time it takes to get delivery of the vehicle from the time that it's ordered, have now dropped to 1 week versus several months not long ago. He views this as a big negative for demand, because this means Tesla can now keep up with orders, meaning they have too much supply, which could lead to excess inventory. Now, normally, this shouldn't actually be concerning to begin with, because in the past, if you wanted to buy any type of car, you could walk into a dealership and take one off the lot same day, and those companies operated just fine, with no complaints of demand shortfalls. Today, however, everyone is having supply chain issues, except that Elon Musk specifically set out to address the extremely long lead times, which were likely having an even worse effect on Tesla's sales. Previously, ordering a Tesla could take 6 months to a year in some cases for delivery, which Elon Musk found unacceptable, and he spoke about how he was going to fix this not long ago. And now that it's fixed, everyone views this as a negative for demand. However, one problem with long lead times is that potential customers can simply go elsewhere during the 1-year time span they're stuck waiting, not to mention that having to wait for months simply creates a poor customer experience. Even the CNBC Fast Money crew can't seem to agree if this is a positive or a negative. On one hand, Steve Grasso says that this is good, it's a tailwind, because Elon Musk is cutting through supply chain issues that plague the rest of the industry. They literally can't produce enough cars, which has been hurting sales for the last year or so. On the other hand, Karen Finerman views it as a headwind, as a negative, saying that there's no lineup, you can just get a Tesla in 6 days, meaning that no one wants the car. But clearly, the faster ordering experience is more valued by customers, also leaving little time to switch their decisions and buy a different car. If anything, anyone waiting in line for an ICE car that's on hold for 6 months can easily buy a Tesla now almost immediately and cancel their other order. So this is a big advantage for Tesla. The argument against it, again, ultimately boils down to demand. If Tesla indeed has enough demand, then a 6-day lead time is amazing. They will sell every car they make and have it delivered almost right away, keeping inventory low. Now, even if you think that the huge level of tax credits won't be enough to spur demand, which by the way is the main purpose of tax credits, or if you don't think Tesla's factory revamp or reduced inflation pressures are enough to lower costs and prices even further, again increasing demand, Tesla still has a few tricks up its sleeve and levers it can pull. One of which is the standard range Model Y, which existed for half a second in the past before Elon Musk took it off the website, citing the range as below his acceptable level. But if Tesla ever maxes out the long range and performance Model Ys, which still seems unlikely for the time being, it can bring to market the lower cost standard Model Y, which was always the company's intention. That also goes against Tony Saganaki's prior comments where he said Tesla won't have a low-cost vehicle for the next few years, but they do, the Model Y equivalent of the standard range Model 3, which doesn't require another 2 years to create a new vehicle platform. And so Tesla has undergone a 62% drop this year, even as the so-called weakness in demand appears to be very short-term, and other bear claims such as bringing Tom Zhu in or reducing lead times actually appear to be more positive than negative. Tesla is counterintuitively still shooting to drastically increase production in the face of demand worries, potentially because they still only make up, along with the EV industry, single-digit percentages of the overall car market. So do you think there are real long-term demand issues at Tesla, and why would that be? Or are many of the concerns actually just short-term, overblown worries that will be resolved in early 2023? Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.